Hi everyone, welcome back to Advisor Lodge. I just want to say thank you everyone for watching. We really had a great time doing the last 9 episode. Unfortunately, like what Roger said, good things always come to an end. This is the last episode.
There's no more free lunch.
Yes, so
no more tips.
We received a lot of questions, I think, really good questions from the advisors. But we can't answer them all, so we'll only be answering the most popular ones that, kind of resonate to what we have always been talking about as well. And the thing is that why is it such a special, episode today is because it's the last one. And also, we are joined by 2 guests today, okay? One is actually Alvin. Hi, Alvin, from iFAST Global Markets.
Hi, Alvin.
Hi, thanks for having me.
No problem. And I think, those who know, he's actually a familiar face.
Yep.
Appears a lot on the social media as well. And of course, another one is our own good colleague, Chian from UOBAM. He's from our multi-asset strategy team. Yes. Hi, Chian.
Hello. Hi,
Chian.
Hi, Roger. Good to see you all again.
Yep. Special guest for today.
Correct. So
That's why we are dressed up also.
Yeah.
Last
So
episode we
we
got
want
dressed
to
up.
look the
A
best.
little bit more formal.
Yes. If not, we always look like,
Too chill.
yeah, too chill.
Anyway, the topics will not be so serious. Don't worry.
Yeah. Okay. So we have, I think, a total of 6 questions.
Yep.
Right. So let's, give the best answers to all these important questions. Okay. The first question. I think this is what I always hear it a lot. Okay. A lot of people don't want to pay for independent financial advice, which is very common. A lot say, I can do it myself. Why
They
I
want
need to
free
pay?"
lunch. Everything they want free.
Yes. Yeah. Why I need to pay, all these kind of things.
It's free.
So, Alvin, in your case, how can I persuade them that it's value for money?
I think even when we talk about fee-based, there are different kind of modality, right? So one modality is that people pay a fixed amount, maybe $500 for a financial plan, right? There's also another kind where you charge a rep fee, more of an ongoing, maybe 1% of the total assets under advisory, right? So on a more of an ongoing basis. So I'm more towards the second type rather than the first type. So I do agree that let's say if you really want people to pay money upfront for financial plan, right, I think it's very difficult. It is not in probably the culture in Singapore, probably in the US or in Australia.
Yep.
They have that culture, but definitely not here, right? And I don't think it's easy to break that culture just because you want to do something different from the rest of the people. I would think that the second way, which is to charge a rep fee on an ongoing basis, I think that is more reasonable because you are serving the client, right? And there are times or there's a period where the client can also assess whether the advisory is working, whether advisory is suitable for the person. And if, let's say, it's not suitable, they can terminate at any time, right? And also that they need to continue to give that value. And financial plans can change. It's not just you buy $500 one plan, you stick with it for the rest of your life. So I do think that the second model is possible. And yet, it is also true that many people still refuse to pay this kind of fees, right? Because if I go to some other advisors, they don't charge me anything. But of course, it's baked into sales commission, trailer fees, right? So I would say that it's part of education to explain what we can do and the value proposition, right? Like what you mentioned, value for money. So I believe that there must be something that we can add value on top of what the products nowadays investors can assess by themselves, right? With robo-advisors, with so many products nowadays, a lot of them low cost, and a lot of information online and podcasts as well. So, so why do you need an advisor, right? So I would say that there must be something that is unique. So for myself, like one of the approaches that I do is a momentum-based kind of investing strategies. So that is where I can add value to how to structure the portfolio, how to improve or get some of the higher returning assets, right? At certain point in time, trying to capture the returns. So that is how I add value. And on another point is that the client must also have that chemistry. I think this is also very important, right? The softer aspect of advisory. You can't advise someone who is not the same vibe as you. It's just very difficult because the client will be second guessing, will be very doubtful about what your advice is, and it's not going to be a healthy relationship. So the trust level must be there. And as an advisor, I can't have many clients.
Correct.
Yeah, I can't have maybe 100-200 clients, right, to really serve them well. I can't have like few thousands. It's not possible to manage. And because of that, I will tend to find clients that can click with me and believe in the philosophy. And it's okay, right? If let's say the client feel that, oh, I don't want fee-based, I don't like your service, or I just don't feel good together with you, I think it's fine. There are a lot of advisors out there.
Correct.
So I do think that fee-based can work. It's just about finding the right client for ourselves.
So I would say that finding the right client is one priority that you need to know, right? Which kind of clients are you going to? But secondly, I will also think that you probably need to show that you can actually value add so that client can be receptive towards you. And in a way, because of this value add, they're willing to pay that, I would say pay that fee, right? Because like what I say, no free lunch, but that value add will probably help client in achieving the goals or, hand-holding during market downturns and volatility. I think these are actually important.
It is.
Yeah. So even for myself, I have a financial advisor. Yes.
I guess the another point probably to add on to what Alvin has mentioned, besides the chemistry between the advisor and the client, make sure that you need to vibe in that sense to with your client as well. The chemistry must be right. But then again, these are professionals. I mean, Alvin is a professional, right? He's a licensed rep, and this is what they do on a daily basis. This is their job. This is their passion. This is what they stand for. In terms of like what he mentioned, this is what he believes in momentum investing and all that. So, end of the day, like I said, there's no free lunch. Of course, like what Alvin mentioned, there's so much information out there in the market, so much more that you can see with with social media so rampant nowadays, right? But how do you decipher it? Because there's always the details, or rather they say the devil is always in the details, right? So that's where you really need to decipher out. And then that's where the value add comes in as well. Besides the chemistry part, as a professional licensed rep, that's where they earn their keep. That I think that's the key point as well. So moving on as well, right? I mean, besides getting an understanding in terms of how this fee-based structure is like, whether rep fee is like, and so on and so forth. But I think there's also a couple of popular questions that we are getting as well. So one of them is also asking referrals. So it means that it's working because this podcast is seen by a lot of advisors. So all the advisors are asking the same questions, right? I think that's the secret sauce, I would say. How do you get referrals? I think this one covered quite a fair bit by our multiple guests.
And I think referrals are also a way to grow your business, right? Yeah. And it probably easier to get the same kind of chemistry of philosophy kind of clients that you're looking for. Referral is always easier. It becomes like a warm lead. So how?
Definitely, I agree, right? Referrals is easier to work with because likely the client who has been working with you put in a good word. The level of trust is already much higher than, say, a cold prospect, right? So definitely it's one of the key ways to grow the business, the advisory business. And how to get more referrals, I would say that there are two aspects. Okay, one is definitely you must deliver the expectation, right? Or even exceed it if possible in terms of, say, performance. Of course, at first you must make sure that the expectation is right, right? You cannot make the client think that you can make them reach overnight, that kind of thing. But to set the right expectation is also part of the process, and along the way, have that performance to meet the expectation, right? So that's the technical part, the hard part. The softer aspect is again the relationship, because at the end of the day, advisory is a relationship business.
Yes.
Okay? Yes. Like what you guys have mentioned, and market go down, how, right? Some of them may panic, and that emotional support is important. Maybe I also can cite another example. Recently, there was this retiree, right? One of the clients is a retiree, and during a talk, then she was asking me, so can I withdraw my money? I know there's cash inside. I say, yeah, you can withdraw your money. It's your money anyway, and you're retired, right? If you don't use it now, you're gonna use it. But she looks like she's very apologetic, Like,
I'm sorry, I'm taking my money
she's
away from
going to
you.
withdraw cash. Right? Because there's just some cash that was not touched.
Okay,
It was just lying there, right? In a money market fund. So she wanted to utilize it to, I think, go for a holiday or what. I said, just go ahead. And I think after a few days, I messaged her. I said that, hey, your money is still there. Do you want to withdraw? And I think she was very surprised that I remembered.
Oh.
Right? Because I think that most people, they're like, this person want to withdraw, just cut it one side, right?
Yep.
Or just act blur, leave longer, the money will stay inside. So I think is that kind of relationship building, that trust, right? Is really thinking from the client's point of view, right? What is good for the client, not whether is it good for me as an advisor. That's, I think, is a very important thing. They must feel that they are valued. They are the center of this advisory, what it's based on. And thereafter she referred another person to my business. So it's something like this that I think the softer aspect of advisory is often overlooked, especially the post, they become your client, the post-servicing, all those things has to be done in order to earn that referrals.
I see. So that's the secret sauce again. FYI to all the advisors out there. When your clients want to withdraw money, remind them.
Remind them, hey, have you withdrawn?
Just one example.
If not, I can do something.
I heard there are other stories like during the Dragon Boat Festival, give dumpling to the clients.
Wow.
Yeah, because
Okay.
don't give mooncakes or bakwa. Because everybody does it.
Yes.
During those period, you must do those niche period.
Wow,
I see.
So there are many
Another
touch
strategy,
points.
guys.
Another
Strategy.
touch
Secret
points.
sauce out today.
Yeah, everybody just
We
so
are in for a treat. The last episode.
yeah,
There are so many
correct,
things we
correct.
know.
Everybody just mooncake.
Yeah, exactly.
They forget the other.
Yeah, 5 boxes of mooncake.
Yeah.
And if you are fifth one, nobody will remember you.
Exactly. True. Maybe we should start giving mooncakes.
Yeah, I also think that. Okay, Chian, coming back to you as well. Thanks, Chian, for coming for our recording as well. I guess you're quite
Most welcome.
yeah, you heard quite interesting
Yes, of course.
anecdotes from Alvin as well. So going back to the markets, I guess. So as we are recording this episode, right? Just FYI, Donald Trump has won the presidency. He is the now anointed US president right now. So for those who are watching subsequently a few weeks after this, you remember this is the day that Donald Trump is being appointed as the president. Okay, but anyway, jokes aside. So with that, right, I think there's a lot of implications coming up.
Yep.
Whether is it the equity markets, the rates, the FX, and I guess inflation as well. So, but closer to home, the T-bills, something that has been Singapore's darling, I would say, over the last couple of years. It's still attractive, regardless of how the rates have moved. I guess right now I think it's sub 3 or just slightly above 3. I think thereabouts. So with FD rates falling as well, I think we have seen it. I think our own bank has also lowered the rates as well.
Yep.
Yeah. So with T-bills and FD rates falling, do you think it's still an attractive proposition for, let's say, Alvin's clients to look at it? Because I think you mentioned there's clients putting money in somewhere, idling over there. Do you think it's still a viable option for them?
Yeah. I mean, I would say that this is a fairly common question that all of us face. I mean, be it my family and friends, they also have cash and things are lying around. And what they do with it, right? It's a very natural question. Yeah. And I would just say that like T-bills, I mean, it's 3% right now, thereabouts. It could keep up with inflation. Inflation could be like 2.5 thereabouts. So it would kind of like barely keep up with it. But I also say that there are actually other instruments, for example, like corporate bonds, high quality, high grade corporate bonds that can yield you about 4% with fairly minimal risk. So that's actually a pickup of about 1 percentage points over fixed deposit rates. And of course, there is also global equities, right? Global equities, the expected returns over a medium term, say 3 to 5 years, will certainly be easily twice of FD rates. So I mean, there is a bit of more vol, but you can definitely get twice the returns on, even for example, just last night, the overnight action, the S&P, is almost like 3% in one day, kind of 2 to 3%. So that's almost a year's worth of FD return, right? In one day. Yeah. So I would just say that, I mean, for those that are, open to a little bit more other instruments besides fixed deposit rates, there will be corporate bonds, there could be global equities that would do fairly well. And I would say that actually in this particular time, in this macro environment, when the Fed just started cutting rates, actually what we do see is that when the Fed starts to cut rates, equity returns tend to be fairly strong, returning somewhere between 14 to 20% over the next 6 to 12 months. assuming that the US expansion continues on. This is actually our base case based on the indicators and our work that we've done. So I would broadly say that actually this is a fairly good environment to be invested into so-called risky assets and keep a close watch. But I think it's a good time for people to stay invested and to get the returns that they could get.
Yep.
Yeah, to retire well, to deploy their funds for the future, for their family, their friends. And
Keyword: stay invested.
Yeah.
Right.
That's a key point. That's
The key point. Stay invested, guys. Yes. So yeah, I think we have it from Chian. He talked about the opportunities as well, right? And of course, I think there's many ways that clients can actually invest as well. Today we see so many instruments out there, right? You have ETFs, you have funds, and basically I think ETF has gained a lot of popularity nowadays, right? They're very synonymous with investor these days. And what we have also seen is that we have funds that are investing into ETF, right? And usually when we talk to a lot of investors out there, there's always two camps. Oh, I'm an ETF guy, I'm a fund guy. So, but what we want to know, or what a lot of the basically advisors out there want to know, is that whether these two products can coexist together or not. Yeah. I think that would be very interesting from my point of view.
I mean, I would say that the arrival of ETF is a great thing, right? It lets investors get into exposures that they can get at fairly low cost, and it's just an efficient way to get the exposures. It could be asset class specific, it could be sectoral segments, it could be asset class geographical sectorial. So I think these are great instruments that have grown. So I think that suits investors that have a very specific idea of what they want to be invested into. So ETFs would fit that very well. I would say, like, for example, for a more like layman investor, whereby they want to be invested, stay invested and be invested in a broad, like multi-asset, equities, bonds, maybe some alternatives, like portfolio. I would say that the funds way of doing it, like funds that are invested into ETFs, is actually a fairly good way to get these exposures. I think the reason is basically the funds, they can actually also do some dynamic allocation. Yeah, so they can tweak the exposures, favoring, for example, equities over bonds when times are good, or when inflation is getting high, they can try to get exposure to inflation hedges. Or for example, if Asia starts to outperform, if there's China stimulus, they could also start tilting the portfolio towards China-related assets. So I would say that the funds approach does allow investors to tap into so-called the expertise or the skills of the fund manager that is able to try to dynamically exploit some of these opportunities along the way. Whereas like ETFs, it would be just buy and hold kind of thing. You'll be just into that sector or that segment.
Index.
And then you'll just be there. But whereas the funds one, they will be tweaking and moving it around so that you can get, other diversified sources of returns along the way.
Yeah.
I see. I guess that's also, I think, what you mentioned about the allocation of the asset classes, within the fund itself.
Yeah.
I think that's important because that's where the active managers are doing, like us, here at UOBAM as well. I guess Chian, he probably knows a lot more on that in terms of asset allocation. So I think, long story short, I guess both should coexist in a client's portfolio. And I'm quite sure, Alvin's clients' portfolios should have a mixture of ETFs and then funds.
In fact,
also.
I think it's blurring the lines between ETFs and funds, right? So there are ETFs now getting more active.
Yes.
And there are
Active
funds
ETFs,
who become passive. so it's like, I think probably a few years later, right, people will start talking about or classifying in terms of funds or ETF, but they will start to talk about whether is it active or passive, whether is it via ETF or funds.
In fact, in my own personal portfolio, I have both ETF and funds. It's just how you want to gain exposure, where you want to have that allocation. Sometimes whether you allocate yourself and a fund manager allocate is different because sometimes you just don't have the time to go and, allocate in some certain sense, right? So yes.
And I think it's great. I mean, for your investors, your clients to be invested in active ETFs, I think that's a fairly good move. Yeah. I mean, this is another new area, because ETF used to be passive, right? They're not active is actually the new upcoming thing, which is by right more intelligent, I guess, in a way, right? To target something. So yeah, I think it's great.
Yeah.
So I mean, as we talk about the asset allocation and all that, right? I mean, this is the time of the year as we are nearing the end of the year as well. So usually, I always have this thought that because more and more people are taking leave, they probably need to clear their leave towards the end of the year. They're probably at home. Nothing much to do, I guess, but then that's where they start to review their portfolios. So that's where they see, how have my portfolio been doing the last 6 months, last 1 year. So Alvin, how often as an advisor, right, should you be contacting your clients when it comes to portfolio review?
I guess it at least definitely once a year, right? But if one can do more, I think there's no harm. Also dependent on whether the clients want that kind of updates, that kind of regular updates. Okay? Because I do see some of the clients that they don't want to be bothered most of the time.
Right.
The degree of trust is higher.
Passive.
They just really, okay, you just help me manage it. Don't kind of disturb me. There are another group that is more active. They may be like checking their performance very regularly, like every week. Then you ask questions. This kind you don't need to schedule an appointment with them because you are interacting with them almost every week.
chit-chat.
Yeah, just chit-chatting. So
You are being interviewed.
Constantly.
but it's also part of the education process. Right? I think it's also good because that's where certain clients voice out their concerns or they voice out the questions that they may have that they don't understand. Then you can take the opportunity to educate them. Right? So some may see that, it's small work, but I think it's more like instead of a routine review, right, you break it down into small chats like this. Right? So I think add up together is probably about the same. And so it depends on the client at the end of the day. But I would say that minimally once a year, right, to keep it warm and engaged. Otherwise, some of the clients may also feel that, hey, how come I'm not being updated of anything? Right? Another approach is also to take note of leverage on certain key events that happens in the market. Right, that there's something important to update.
Like current one?
Yes or no, it's just more gossip. But you can, right? Because it's top of the town.
use it as an excuse.
Yeah, use it as an excuse. You can just reach out to them. Things like that. There are some other advisors who also shared their approaches. Sometimes certain major events like this, or even if a market drop, you can ask them to put in more money because it's cheaper now.
Right. Agree.
If market go up, because you must invest now because otherwise, the long term wise, if you keep too much cash, it's not good to compound your wealth that way. So I think using key events and touch points like this can help. Can help to engage the clients.
Yeah. Okay. I think there you go. You need to either review it on a very regular basis. But I also think that, those clients will always ask you this and that. I think it's a kind of rapport building as well. You just get to know them.
The more they ask, the more you know.
Yeah, the more you know, then you know exactly what kind of questions they might ask, where they are more interested in, and that creates good profiling for you.
They may have secret stash somewhere.
Yeah, if their clients is okay, right? Because they have invested money. I think the challenge is sometimes it remains as a non-client. But then they start ask you a lot of questions, right? I think that's where the boundary needs to be drawn.
Yep.
I cannot give you advice unless you're my client because
Exactly.
it is dangerous.
Yes,
Right? If you take something which you may misquote me or what, and you go and implement yourself and something goes wrong, right?
Yes.
Yeah, that's where things get ugly.
Okay, guys, pro tip, yeah?
Just you can use it to say that I have not done any KYC.
It's true.
That's how to get referrals again.
Yeah, talking about major events. So coming back to you, Chian, right? What are the top investment ideas for 2025, right? Especially in the lights of recent
Investment tips come already.
Trump. So yes, I think this is the one that
we have
is the
investment
main-
tips and we have advisory tips.
Yes, I would say that this has been a fairly anticipated event. We've been thinking about this quite a bit, even before this outcome. I have to say that the team has really kind of put together like some ideas of where we think things are. And for example, I think we did kind of expect higher interest rates to be higher and also the dollar to be stronger in this environment. So I would say that I think actually the investment overall, the overarching investment style, I think is still not too different over the last 1-2 years. I mean, we saw how global equities have done last year, this year. Next year probably would not be as strong given we are seeing almost 20% returns last year and this year. Next year would probably not be as strong, but I would say that I think the theme for risky assets to do well would likely stay given that the global expansion is still expected to hold up. So long as, there could be a little bit more volatility or uncertainty depending on how the Trump policies come into play. But I would say that, currently I would say that I think for example, the lowering of the tax cuts, that would be a positive for the economy. And so I think that is one factor people are looking at. So that's good for growth, and I think corporates would do well. Business investment sentiment should be strong. Yeah, I think the only other things to consider would be which sectors or segments or asset classes would do a little bit better under a so-called higher rate, stronger dollar environment. So I think that's otherwise I think environmental style I think is pretty good. Earnings growth is still projected to be fairly healthy next year, and base case expansion outlook for the economy is still a fairly good one. I think the other area to watch with, for example, might be China or Asia, especially depending on how the stimulus that should be announced pretty soon, how that comes around, and how the policymakers would be more forceful in wanting to put a floor to the overall growth trajectory for China. So I think these are opportunities that we are watching out for, and I think investors would be clients would be well served to be invested in risky assets, bonds or credit bonds, high quality bonds and equities.
There you have it.
Yeah, it seems like just stay invested. I think that's the key message.
Next year, guys, you haven't do anything, please contact your advisors.
Look for your advisors, speak to them, talk to them.
2025 still looks good, man.
Now is the time to look for them. And ask them what are the key tips. For any more tips, please look for us as well. We're happy to share more tips with you.
Or look for
or look for Alvin,
yes.
We're coming from
Whoever you can fight with.
okay, that's a good one.
Okay, I think these are the 6 most popular questions, right?
We hope you answer most of them as well.
Yes. And I think, in fact, actually, all these questions, if I look at it, in every episode, we kind of cover here bits and there, but, I think advisors, they still want to understand a bit more from different perspective, and I think this is good. But unfortunately, this is the last episode, and,
good things come to an end.
Yes, but maybe you might see us again.
Season number 2.
Maybe.
Coming to a theatre near you.
But this one, we need to see what is it planned for us.
But in case, we love this. I think we enjoy doing this as well. We thank all the guests that have appeared in our previous episodes as well. We started off as in a small meeting room, I guess, just 2 of us and our guests as well. It has evolved, to such a beautiful studio that we have here today with the iFAST TV crew as well.
So we thank iFAST, right?
We have to thank iFAST TV as well. And all our guests, whether it's our internal guests,
or external guests,
our external advisors and all that, I think it has been a great journey, I think, to go through the last 2-3 months. And I think all of you out there, I think you guys have learned quite a fair bit.
Yes.
And whether is it from the markets, whether is it from the advisory standpoint, we have dished out, I think, lots and lots of tips.
Yeah.
I think I lost count of how much we have done through as well.
I also lost count, but it becomes very natural already. So
So thank you, everyone. Thank you, Chian. Thank you, Alvin.
Thank you.
Yes, thank you.
Thank you.
Thanks,
guys.
everyone. Cheers.
Cheers.
Merry Christmas.
Merry Christmas.
And a Happy
and,
New Year.
all the best
Bye.
in 2025. Bye-bye.